Hi, this is Terry, and what I'm going to try and do is some job order costing with you. Job order costing, by definition, means that you're in a manufacturing environment. So before, on your assets, let me get that written in there, you would have cash, accounts receivable, inventory, and that inventory was your merchandise inventory. It was all the inventory that you bought from other places, and then you turn around, marked it up, and sold it. In a manufacturing environment, that inventory account is going to be replaced by 3 inventory accounts. You're going to have a raw materials account, you're going to have a work in process, and you're going to have a finished goods. So you'll have 3 inventory accounts, and what you'll want to do in your accounting records is keep track of where all your resources are in each one of those accounts. All right, so let's kind of switch this layout here. Let me get rid of it here. Here we go, and we'll start over again. Let's go this route. The very first thing that you'll do is you'll have your materials account. And that materials are all the resources that you're going to go out and buy. And by definition, those are going to go out into your warehouse. So the physical location is going to be your warehouse. And what you'll do is you'll debit your raw materials, you'll debit your materials account, and you'll credit something like accounts payable or cash. Then we'll work with an account called work in process, and that's your factory. And in that work in process, you'll have some materials that you'll transfer in. You'll have other materials that'll go to an account called overhead. The materials that are traceable and worth tracing go into work in process. Those are called direct materials. The materials that are like grease for the machines or rags to clean up, those are indirect materials, and those go in as a debit into overhead. So what you would do is you would debit work in process and overhead account and take materials out of the materials account. Then, on top of that, you're going to add direct labor. And direct labor, by definition, are all the resources or all the dollars that you spend on labor that are on a hands-on sense. So your direct labor would go into work in process, your indirect labor would go into overhead, and you would have wage expense for anything that's not part of the factory but for the company. So in other words, that's your selling and general and administrative. So you would debit work in process for your direct labor, debit overhead for your indirect labor, debit wage expense for your selling and administrative, and then credit wages payable for the sum of all 3 of those. Then we have a goofy account, and we're going to kind of slide it over here, this overhead account. The problem with the overhead account is that you have all the actual bills coming in, and then you need to apply that overhead because you don't know, all these bills coming in, you don't know what they are. You don't know what the property taxes are until like July or August. But when you finish the job in June, or January even, what you have to do is figure a means of charging that account for overhead. And overhead by definition is anything that is not direct materials, that is not direct labor, but is part of making the product. So the supervisor's salaries, the indirect materials, the indirect labor, property taxes on the factory, insurance on the factory, anything to do with magazine subscriptions in the lunchroom in the factory. If it's not, doesn't go into direct materials or direct labor, by definition, it goes into that catch-all account. So what we do is we pre-calculate what the overhead's going to be. So we take the estimated overhead for the entire year and divide it by some estimated cost driver. So this may come out machine hours, labor hours, or labor dollars. Those are the 3 most common. So if you worked 10,000 labor hours and you were going to apply at a rate of $8, if this came out to be $8 per direct labor hour, then you would just take the number of hours times that $8, and you would take that out of the overhead account. So you would apply those goods and put them into work in process. Once you have that work in process account, that you have all the materials, all the labor, and the overhead, those are your product costs, then what you'll do is move them out of the work in process and send them to the finished goods, which is the finished goods warehouse. And the total amount that you move over has a special name. It's called the cost of goods manufactured. And you'll put that into the finished goods. Then the finished goods at this point here, up until this point, these are all inventoriable costs. These are all goods that are going to go onto your income statement in your inventory account, so they're all assets. The matching principle says that you can't have an expense until you have a revenue, so it isn't until you sell them that you take the dollar value out of the finished goods and go debit that to the cost of goods sold. So you would debit the cost of goods sold, credit finished goods. This cost of goods manufactured is a big deal because it tells you for that period what did it cost you for those goods that you manufactured. Exactly what the title says. So if you take the cost of goods manufactured and divide it by the number of units that were completed during the current period, that would give you a cost per unit. So I'm going to see if this will let me add a slide, because what I want to do is the cost of goods manufactured schedule. So let me see if it'll add.